Hey everyone, what's up? Today I'm going to be doing an analysis of American Eagle, as you can see here on MSN Money. And I'm also going to be talking to you about the three main financial statements that I use to analyze a company. And in case you haven't noticed, this is the first time I'm using screenshots, so I'm a little new with the software, so if it's a little rough, be patient, but it should get better over time. So I'm going to switch to webcam now. So let's talk about the three statements that I use to analyze a company. Those of you who are familiar with investing or went to business school, this will be common knowledge, but to those of you who are newer to investing, this is super important to know. So the three main statements are the balance sheet, the income statement, and the statement of cash flows. And basically this is the major source of quantitative data that I'm using to analyze a company. And I'm also using these statements to create ratios to gain further insight into the company. So basically I use the balance sheet to determine the financial strength or position of the company. I then use the income statement to determine the quality of earnings. Now the cash flow statement is kind of a mix of the two, and it's arguably the most important statement because when you're making investment, essentially what you're looking for is cash flow. And basically the strength of the business is the strength of the business's cash flow. And it also gives you a gauge of how management is using the cash. Are they investing it? Are they buying back shares? And all these things can be indicative of the financial position of the company and indicative of what management thinks of the company, and sometimes can allow you to see things that you wouldn't otherwise be able to know with just the income statement and the balance sheet. So now I'm going to do a quick analysis of American Eagle because I'm wearing an American Eagle t-shirt. So I'm going to flip back to MSN Money. So yeah, I really like to use MSN Money to get an initial look at a company. So the first thing I'll usually look at when I look at a company is I'll look at the PE ratio, which is the price to earnings ratio. So as you can see here, American Eagle Outfitters, it gives you the stock symbol. Okay, you can search it on Google. You can just go American Eagle MSN Money. Just search it, then you click on it. And if my internet's fast, it'll bring you here. So now since we have that, the first thing I usually look at is the PE ratio. So here we have a 14 PE ratio, which is, pretty low for a company like American Eagle. And this is usually trailing 12 months. So it's for the last 12 months. What's the PE ratio? So after I look at the PE ratio, the next thing I'm usually going to do is I'm going to check out the income statement. And the reason I do that is because I want to see if their earnings are similar through time. So if you look at these earnings really quickly, you can see it went from 179 to 169 to 140 to 151. And this is in 2009. So these earnings are looking pretty good, I mean, after the financial crisis and everything, and it's relatively stable. For some reason, there's bigger earnings this year. So I look at the earnings. I know it's an American Eagle. I know it has a strong brand, so it should be relatively stable, and it looks pretty stable, except here there's a big increase in earnings for some reason. So the next thing I'll do is I'll look at the numbers here. So total revenue. You can see their revenue is increasing, so that means it matches their earnings. The gross profit looks pretty consistent, just like the earnings. Operating expenses, pretty consistent. Operating income, a bit higher here. Pre-tax income. And basically what I'm looking for is there anything weird that I should be looking for in this area that would affect this, that would explain this. And so far it just looks like they had more revenue than usual. I'm not looking too in depth, I'm just doing a skim. So I'll go to the balance sheet. So I'll look at the balance sheet, and you'll notice it's in quarters. I'm not really interested in quarters, I'm more interested in annual. So I'll put on annual. So if I look at American Eagle, you look at their total assets and total liabilities, and you can see Their assets are much greater than their liabilities, so that's a good sign. More than 3 times the amount of assets than liabilities. That's a great sign to begin with. Now I'll look at their current assets to total current liabilities, also looking good. More than twice the total current assets than the total current liabilities. Then what I'll do is I'll take a look at their cash. 631 cash for total current liabilities of 435. So that means they can totally cover their current liabilities with their cash, which is a great sign. Chances are they're not going to go bankrupt anytime soon. You go more in depth, but that's just generally looking at that, it looks pretty good, And you could notice that their liabilities at this time were 0. So there's something weird going on in 2011. You'd have to look deeper in the company to see that. But overall, it looks pretty good. So that's a quick skim of the balance sheet. Then I'll look at the cash flow statement. So when I look at the cash flow statement, there's three main things that I'm looking at. I'm looking at operating activities, investing activities, and financing activities. And ideally what you want here is you'll notice the numbers in red means it's negative, see negative, and the numbers in black mean it's positive. And the ideal situation is the cash flow from operating activities are positive, the cash flow from investing activities are negative, and the cash flow from financing activities are negative. Because basically what you want is you want a business that is generating positive cash from their operating activities and using them to invest or using them to finance in order to get more operating. What you don't want to see is businesses that are losing money from their operating activities and are staying afloat by investments, selling off investments, maybe their machinery, whatever, or by selling or by raising more equity or by raising more debt. Because essentially in the long term, the business has to be able to sustain itself with cash from operating activities, right? So here it looks pretty good. I mean, they have cash flow from operating activities as positive. They have negative cash flow from investing activities, so they're buying investments, they're investing in the business, and they have negative cash from financing activities, and that's because they're paying large dividends. And if they paid especially large dividends this year, so that's a great sign. And you'll also notice they're buying back stock, and that's usually a sign from management that they believe the company is undervalued to some degree. Okay, so here you notice a change in cash of 210. They have less 210 cash. That's because they probably had a very high cash position, which they wanted to get rid of. If you remember from the balance sheet, they had more than enough cash to cover their current liabilities. So too much cash isn't a good thing, So they gave it back to the shareholders, which is, great for management. Although maybe it would have been more effective to buy more stocks, but they mustn't have thought their stocks were that overvalued. So overall, I mean, American Eagle is it's so far looking good. But you'll notice at this point, I still can't really make a purchase or not purchase investment. In order to do that, I have to go deeper in the company. But so far, from what I've seen, it looks really good. Okay. So pretty much here, I just did a quick skim of the balance sheet and the income statement and the cash flow statement. And you'll notice that so far everything looks good, but to really make an investment decision, I have to look deeper in the company. I have to look at an annual report, I have to read some news reports. But so far American Eagle is looking like a pretty good company, And really what you're doing is the few things we saw that were kind of sketchy or I wasn't too sure about why, those things I would have to look further into and to reevaluate. Also, you'll notice that this year the earnings are a little higher than usual. So the question I would be asking is, are those earnings this year the sustainable level of earnings and the other ones are just depressed earnings from the recession? In that case, the PE ratio of 14 is justifiable and would possibly make a good investment. However, if the raise in earnings for this year is the exception, then it might not be a good investment because the price is too high. But so far, American Eagle looks like a pretty good company, and maybe I'll look more into it in the future. For now, I can't recommend to buy, but I'd say it definitely looks pretty good. Anyways, till next time.